Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
right. Let's start. So here's our final class. Let's make it count. All right, so this class, as we have done in the mid-semester review, is going to be focused on helping you to prepare for the final exam. It's going to be loaded on the Waddle, so don't worry about this. So before I go on, I just want to highlight your attention to the video that I've made on Monday on investment. Please go and take a look at it. It's examinable material. I spent a lot of time working on this. I had to record twice, actually 3 times. So I spent a lot of time on doing this, and I wish that it would have been possible to have a makeup class, but because of the final week and because of the public holiday, it was very difficult to manage. So yes, so please go and take a look at the video. It's going to be highly relevant. Okay, so consultation hours. Extra consultation hours are going to be like not including this week's consultation. Starting from next week, you will still have consultation from the original time, plus on the Friday. I was going to put in June 10th as well, but I just realized it was another public holiday. So you can't get into the building, and I cannot schedule consultations on a public holiday. So you will, and I also checked your exam schedule. So you have exams in the morning, so I moved it to the afternoon as well. So you'll be able to make maximum use and ask me questions. All right, any concerns about this? Okay, very good. So as in the previous mid-semester exam, if you have a question and you want it to my attention, definitely email me, but before you do so or while you're doing so, do check the course forum, just in case somebody else has answered a question, has asked a question and I have answered it, right? So then you will get your answers immediately rather than have to wait for me. But I will make sure that I will monitor and answer questions on the forum every single day, probably in the evenings. Materials permitted in the exam: paper-based dictionary, non-programmable calculator, just as before, and now you do have the formula sheet as posted on Waddle, right? So that's what you can expect to see at the end of your exam papers. That and nothing else and nothing more, all right? So just get used to that, be prepared. Right, so that's where you will be able to find the course forum as well as the course announcement page. So if you noticed, I actually spent a lot of time writing on the course announcement page as well as the class forum page. Definitely refer to those for any announcements that I have to make afterwards. Oh, right. So this is the formula sheet, as you will see on the final exam. So go ahead and take a look at that. That will be copy and pasted directly into the final exam. So I haven't done the final exam yet, not completely. So you won't be able to see exactly what it looks like, but it's 2 hours still with 15 minutes reading time, just as the mid-semester. So in terms of how many pages, I'm not sure because I haven't finished doing it. And so you can expect exactly 7 questions. You are going to expect 2 bonus marks as before. And I don't know how much marks would it be. But all of the requirements are exactly the same, and I will highlight your attention to this requirement. Only answers written on the provided script books would be marked. Right? Because otherwise, all of the scrap paper, they are taken out of your exam and they are sent off somewhere else. So you are running a really huge risk if you wrote on those scrap paper, right? It's very likely that your marks on those are, your answers on those are not going to be marked. Okay, very good. So Exactly the same format as you would have seen on the mid-semester exam. The first question is it's composed of 4 multiple choice questions. The last question is a bonus. And then you can expect a mixture of computation and theory questions from questions 2 to 6. And those will contain multiple parts, just as you have seen before. And the format and the style that I asked them would be similar to mid-semester exams, as well as all of the problem sets. So time allocation, let me stress this again. It is very important that you're going to take a look at the mark allocation for a specific question and then allocate relevant time to it. Because I had students who told me that they were spending about 10 minutes on a 1-mark question precisely after the exam. Please don't do that, because that's not a risk-adjusted high reward for you, right? We're talking about the best reward for you. So let's go for better time management. It will be somewhere around this mark because, again, when I make the questions, I follow this so that I will time how you should answer questions. But I'm not sure if it's exactly going to be 75. Calculation questions, again, the same as before, but I would just like to emphasize, based on what I have seen in the mid-semester answers, that you need to show the steps so that it is very clear to the marker how the answer is obtained to get the full mark. Otherwise, if you just get a numeric answer with a formula, that is not going to be worthwhile. And so the way that you will answer questions, refer to class notes, problem sets, answer keys, and the mid-semester answer key for examples. Short answer questions. Again, very similar to what your mid-semester review questions are. And in the final exam in particular, because we're talking about accumulation of all the different topics and the big 4 parts, there's going to be a stronger emphasis on your ability to connect between different points. You would have seen examples like that in your problem sets, right? We connected international parity conditions with the foreign exchange exposures and so on. They're integrated into the same question. You would expect to see that on the final exam, right? And so the connections between different concepts are going to matter. And whenever you're answering anything, make sure that you are approaching the question from multiple different perspectives. There definitely is going to be a pro or benefits or the cons or the concerns that you will have. So think carefully through all of those, and then think through what kind of logical, economic, and financial intuitional explanation that you can come up with. So any questions that come with these kind of tag words, discuss, describe, interpret, explain how, why, you're expected to explain everything, just as in the mid-semester exam. And if you're explaining things, make sure that they're in the correct order, because you could have a point in there that matches the answer, but if it is not in the correct order, it's incorrect, right? Because logical sense makes a lot of, it contributes to a correct answer. So the same thing, 60% to 70% of the exam should be pretty straightforward to you if you understood all the class material. But so that means that you have to do very hard. You have to try really hard to fail it, right? I don't want to fail people. So, but I also emphasize that in order to get into the HD category, a lot more is expected as well. I made sure that I read all of the HD and all the marginal D questions on the mid-semester, and I thought that it was awarded quite fairly, right? So again, I'm very transparent in what I expect in the marking scheme. So it should not come as a surprise, but I do acknowledge that there is a lot of concept in here. However, these concepts are interrelated. So hopefully through this review session and through practicing other problems, it's going to come a bit more natural to you. So study material is exactly the same as before: lecture notes and recording, problem sets, class questions, review questions, Wordle quiz. I emphasize again, because in the mid-semester review there were a few questions on the past midterm and exams, the material are highly different. I even used a different form of notation in the previous years, so those questions may not make sense to you. And also, I didn't cover specific topics in the past exam, and I covered new topics this time around, because international finance is such a fast-moving subject that I'm always updating my material. So they were only intended to give you an idea of my exam style, but you already have an idea of what my exam style is, so just try to focus on this semester. And I emphasize also that I don't believe in surprises. If I put a question in the exam, I think once, twice, thrice, many times to think whether or not it is something that we have done over together in class, or it is something that I have shown you in examples, in problem sets, right? It is not to surprise you with something, but that you are able to understand how to approach solving a question with the framework that we have developed in class. So hopefully nothing will come as a surprise to you, because as you know, I stand by my words. Okay, any questions before we go into the course review? Yes? Sorry, could you repeat it? Oh, okay, so the question is, if the pre-mid-semester material that has already been covered in the mid-semester, will we expect them to be covered in the final exam, right? The answer is yes. No. No. The answer is please do expect them to occur, right? Because if they were important in the pre-mid-semester era, they will be important throughout this course. Okay? So it is cumulative. So please expect things to be examined, because things that are tested before the mid-semester are now assumed knowledge, right? I will go on and design exam questions assuming that you will know those topics well, right? It's just like you go on to other courses, you go on into actual career, they are going to assume that you remember everything that you have done in your school. Well, most of it anyways, right? So it's cumulative. Questions? Including balance of payments? What kind of balance of payments? Yes. So the short answer is yes. But after thinking a little bit as I walk back here, I think it is safe to expect that I will not go into as much detail as I have done on the mid-semester exam on the balance of payments alone. I have this very bad habit of trying to give you as much as I could. Okay. All right, any other questions before I go into the course review? Yes? Pardon? What is the percentage of material from the pre-semester material? Very good question. Okay. Very good question. Okay, so I think about why don't I just finish going through this and then answer this question at the end? Okay. I need some intuition. Okay. All right, so we have done 4 parts of the course so far, right? 4 big parts with 10 different topics. Some of you asked me, it seems like that you were rushing quite a bit in the last part, covering quite a lot of topics at the same time. However, that is actually intended because if you would have noticed, in the first part of the course, what we have done are basically the foundation theories, right? You would have had to know all of these different definitions and theories in order to go on and apply them in real life. That is why I took a long time in going through each of those in a lot of detail, right? So the first 2 parts are going to be entirely on the theories. So we went through the part 1, international financial framework, which we talked about the general setup of the financial markets, especially for the FX markets, and quotes, different quotes, quotation styles, and how are trades done. And then we talked about very specifically about how our prices for foreign exchanges or different currencies are determined. And in these, we had topics 2 to 5 covering those. So those are the pre-semester material, right? So we cover through the history of the international monetary system. We look for the balance of payments, which is actually very important because that tells you the supply and demand story of the price determination. And then we have the international parity conditions, which give you the IRP and the PPP way of determining the future exchange rates based on the spot exchange rates, right? So those are very important. And then we talked about FX forecasting and arbitrage and speculation. So all of these are just the theories that lay the groundwork for the future applications. So that's what we did in the parts 3 and 4, in the latter part of this course. So basically you understood how is the financial market organized and how are the prices determined. So what kind of foreign exchange exposures are we trying to manage and identify? So that's what we did in topic 6, which we separated into parts A and part B. And then we actually had a really fun time, I hope, looking at all the applications, because now we have known the groundwork of everything. Now let's take them and actually reduce cost of capital and increase opportunities that we can have access to, right? So that ties back into the first class that we had. Why do we care as a firm about expanding into the international market? It is to reduce our cost of capital, to increase our expected return in order to maximize firm value or shareholder value, right? That is the bottom line for our study here from the perspective of a firm, right? So the first few topics here is how to reduce the cost of capital. And this one here is to increase expected return. So overall, they together will increase, hopefully, firm value. right? Because for a firm to expand from the domestic market into an international market, there must be some gain from that. Firms should not do anything just for the fun of it, but they should have a clear decision based on financial considerations, right? So that is how we have approached the idea. Okay, so they are interlinked together, and all of the topics in 6 up to 10 relied on what we have done in topics 1 to 5. So they're tightly linked together, and it was very important to have a clear and solid grounding in the first 2 parts, because they're the theory that underlie the entire framework. Okay, so in part 1, what we have done and gone through, we have already talked about. Basically, is the organization of the International Financial Framework. So those ones, I'm probably not going to test directly on those, but obviously you are expected to read whether these are direct quotes, indirect quotes, and so on, right? So this should come as second nature. And I'm definitely not going to have a direct definition-based questions on this topic. That's wasting your time and my time. Topic 2, the history of the international monetary system as well as the balance of payments. So we went through different kinds of periods or regimes that foreign currency prices are determined throughout the world. And just looking at this, I'm very clear also that I'm not going to have definition-based questions from this topic as well, right? So again, it would be assumed that you know that we're currently under the sort of flexible exchange rate regime, but some countries are under more of a managed peg, while other countries are more of a dirty float system, right? So that is something that we will be based on. And then we also talked about the beloved balance of payments. So from my perspective, am I going to go into questions such as debits or credits? No. Okay, I won't. So I can tell you right now that I'm not going to go through the questions in question 2 in the mid-semester exam, where you're given a transaction and you have to come up with explanations for how to put it into the balance of payment. All right? So I'm going to write this down. Q2S in parts A and B, I think there was another part which was whether the current account was good or bad. I think it is still important to have the intuition for looking at how to interpret current account deficits or surpluses. I think that is important, right? If you leave this course with any knowledge from balance of payments, I think this one is important. Right, so this is important. But again, I'm not going to ask you to explain how a certain set of transactions should be split into the current account or the capital account. Okay. So topic 3, now we start into part 2. Basically, we have been focusing on how the currency prices are determined in terms of different kind of theories. So the first and foremost one is exchange rate equilibrium based on supply and demand. I think this is very important because if you leave this course without knowing this, that would be really bad, right? Supply and demand forces, it's the basic economic forces that change and shifts demand for a certain object, in this case, currency. So we should know how supply and demand would affect prices. So this is important. Government interventions and foreign currency interventions, the definitions, this is also very important. So yeah, so I think this is pretty fair game. Topic 4, international parity conditions. So basically we talked about purchasing power parity and interest rate parity. And then finally we linked all the different parity conditions with the Fisher equation as well as the forward rate as an unbiased estimator. So you would have seen examples of how I would refer to those in the problem set questions, right? So problem set number 4, I think used these conditions quite extensively, and you would expect to see them in that way too. And again, I really emphasize more on the intuition and the interpretation rather than the actual formula. So does certain things hold in reality, why or why not? Those are really important. So the economic intuition in any topic is always really important. So those are fair game. And also knowing the assumption that underlies all of these theories is also important, right? Because otherwise, when you're applying it, you don't know when when certain assumptions are violated. And so your formula may not hold as such. So I think knowing the assumptions are also important. So topic 5, we talked about forecasting. So there are 3 fundamental approaches to forecasting with efficient market hypothesis, fundamental approach, and technical approach. So we're now in untested grounds before, so everything is game. And then we talked about speculation. Speculation, basically, the idea is that you don't have guaranteed profits because you're taking a view of the market's trend, and you're taking a gamble. So whatever profits that you are calculating are what we call expected profits rather than guaranteed profits, as in the case of foreign exchange arbitrage. So we talked about speculation, whether the activities of speculation, even though governments do not like speculation, how it could be welfare enhancing because it contributes to price discovery. So speculation could have an economic value. And then for arbitrage, we talked about how we computed different forms of arbitrage. And the most important idea when you are doing any arbitrage questions is to first calculate the theoretical no arbitrage rate. And this can arise because of information asymmetry or transaction costs. But the step one that you always do would be to calculate the benchmark. And then you compare this benchmark to the current market price. So if the current market price is too high, then you are going to sell high. If the current price is too low relative to the benchmark, then you are going to buy low, right? So that's how we always go for buy low and sell high. And then we also talked about how with algorithmic trading nowadays, a lot of these discrepancies in prices between the market price versus the benchmark theoretical no arbitrage price, the opportunities are just getting less and less. And also we have shown that whether it is speculation or whether it is arbitrage for the individual or for institutional investors, the profit margins are very small. So in order to gain big profits from arbitraging, you will have to have a lot of initial investment into it to make the size bigger in order to have a sizable amount of return. So that is why it makes it quite difficult for individual retail investors like you and I to get a lot of return from arbitraging. So we did a few special topics in this case. We talked about the European Union, Eurozone, and Brexit. There was the problem of coordination. I think each party knows what a common good outcome is going to be, but each is more concerned about their individual gains. So it was very difficult to achieve a common outcome that is good for everybody, right? So we did a game before the mid-semester exam, and we showed that it was very difficult to do, coordination problem. And this is an ongoing topic because Theresa May just resigned, and there's going to be ongoing uncertainty in the British European markets as a result of the ongoing saga with the Brexit. So it's very topical. I will highly recommend that you take a look at it. And then we talked about Turkish currency and debt crisis in 2018. We talked about how and why it happened, what are some of the consequences, what did the Turkish government try to do. So that was included as an example of government intervention. And then we talked as an interlude in IRP discussion, the Euro currencies market, which we talked more about in topic 8. So we already defined what are Euro currencies and Euro banks. And then, as I promised, the part that is examinable from Dr. Tan's guest lecture is actually related to the Q&A. The question that was asked by Walter, that was highly related to the topics 3 and 5. It was highly related, and I think it was useful, right? Because it summarizes basically our entire discussion in part 2 of what kind of macro factors do you look at in order to predict foreign exchange movements, right? So basically, the idea is that what do you do when you're trying to predict foreign exchange rate movements for a country? And Dr. Tan's response was, do you remember what Dr. No? Okay, so Dr. Tan's responses was to really focus on the economic fundamentals, right? To really focus on the economic fundamentals. What does that mean? Basically, we talked about the key drivers of exchange rate determination in this part, right? What drives the supply and demand for a certain currency? So in the case of Australia, what really matters for Australia's economy? What matters for Australia's economy? So to think about that question, we should think about what generates the biggest amount of GDP for Australia. Exactly, natural resources, right? And commodities, iron, coal, and so on. So the price fluctuations in the commodity market would be really important for Australia's market, right? What else? So if you're looking at this slide, what other factors would you be looking at? Whether or not you're expecting an interest rate cut by the government, right? Whether or not the inflation rate is going to increase or decrease, right? That's going to have impact on how the exchange rate is going to go. We talked about those. And then are you going to expect any government interventions in the short term? So we're talking about, for example, the Fed or the RBA or the ECB. Are they going to exercise more quantitative easing programs, or are they going to wind down the quantitative easing programs, right? So that will have implications on whether there's going to be more demand or more supply in the market, right? So, And he also talked about how looking at all of these factors are easier for the prediction of foreign exchange rates in developed markets, right? So he talked about how prediction was prediction based on fundamentals more applicable in developed markets. And then he also used Nigeria as an example of how predicting foreign exchange forecast, predicting foreign exchange rate in Nigeria or other developing countries to be more difficult. And why is that? Yes, precisely, because of volatility and lack of data, right? So for countries that are developing, basically you have a lot of uncertainties. You could have corruption, you could have government intervention that suddenly came out of the blue. You could also have governments that are changing from one day to the other, from political coups, right? So all of these contribute to a lot of uncertainty in a country's fundamentals, right? Even if the economy was doing really, really well, but for a developing economy with high political uncertainty, then things can suddenly just come out and affect the supply and demand of foreign exchange in that market. So uncertainty is a key point, and because they're developing and they don't have the infrastructure to collect all the relevant data from the economy, so doing fundamental analysis in developing countries is much more difficult than for developed countries. Because if you want to pull data for inflation, for interest rate, for GDP, first of all, you're concerned about data quality, even if it exists. Second of all, you may not be able to find the data, right? So it would be very difficult to conduct a fundamental analysis as you would do for a developed economy. Right? That is why a lot of our research is done, academic research is done based on the US market. Not because the US market is the most interesting, but because data on the US market is the most available and most publicly available. So data availability plus uncertainty in developing markets make it much more difficult for fundamental analysis. But Dr. Tan said that overall, what he does daily to predict foreign exchange rates is based on mostly fundamental analysis and also just getting to know the economy, right? You need to know about the economy. If it is a developed market with stable fundamentals, then it makes it much easier to predict. And if it is a developing economy, then on top of the fundamental analysis, the political uncertainty and other uncertainties, plus the data availability issues, make it much more difficult to predict. All right? And again, I think this is highly related to our topics 3 and 5, so that is why I jumped at the opportunity, and I really thank Walter for his question. Okay, so that concluded our discussion for topics 1 and 2, and we entered into topic 3. So for a firm that operates in the international arena, they are exposed to various kinds of exchange risk, foreign exchange risk, and so we have to be able to identify them and also to quantify and manage them. So we talked about 4 different types of risks. We talked about transaction risks, economic risks, translation foreign exchange risks, and contingent risks. And contingent exposure is basically exposure that depends on third parties' decisions. that you are unsure yourself. So it is expected that you are able to distinguish between what each of those are, as you would see in the problem sets. And then once we know what they are, we are able to quantify and measure in order to manage them. So here we spend a lot of time on value at risk calculations, where we apply them to a single currency plus a portfolio of different currencies. So for this one, you already have the formula on the formula sheet. You just need to apply them. And then we talked about how to use sensitivity analysis with probability attributed to different scenarios to measure economic exposure, and also using regression analysis to measure economic exposure. And then finally, we talked about how to manage the risks that we have just identified and measured. So there are two major approaches through natural hedge or hedging with financial contracts. So the idea with hedging with financial contracts is that you have to be able to compare the different costs associated with them, because hedging doesn't come for free. Right? So hedging doesn't come for free. You have to be aware that by hedging it, you are not taking in future probabilities of favorable foreign exchange movements to you. You're locking in a certain price now. And then we talked about how if there are ways to adjust the operational structure of a firm, then we are able to reduce the net exposure overall. So basically, by changing the organizational structure, by matching accounts receivables and accounts payables in foreign currencies, we're able to reduce the overall need to go into financial hedging, which is going to reduce your cost overall, right? So basically, for a lot of companies nowadays, they're going to go look at their organizational structure first to look for natural hedges before they go into the financial markets and conduct financial hedge, because financial hedge comes at a cost. And then we also talked about arguments for and against hedging, but all of those are based assumptions of perfect competitive markets. There is information symmetry, and there are equal access to the financial instruments that we have, and so you have to be aware of all of that. All right, so that finished our discussion of the third part, and we go into applying what we have learned in the first three parts to actually raise capital on the international markets and also make international investments. So that's what we did for topic 7 up to 10. So in topic 7, this basically lays the groundwork for 8 and 9. So basically the idea of going into the international markets to raise your capital is to reduce cost of capital and somehow increase your expected returns. And we talked about the WACC, weighted average cost of capital, which you would have been exposed to in FinM 7007, which can be separated into the cost of debt, which was our focus on 8 and 9, and the cost of equity, which was our focus on 9, right? And so when we're calculating the cost of equity, if we have international financing, then we have the separation between the domestic CAPM versus the international CAPM. With the international CAPM, we have scope for a lower cost of capital because of the scope for diversification, right? So the beta that you have, as well as the returns on the market that you have, instead of being the international portfolio, instead of being the domestic portfolio, you have the international portfolio. So there is scope for diversification and reduced cost of capital. And then we started talking about sources of different international funds, right? So we talked about how, remember that diagram where you had internal capital available to you, and then we have also external capital. And then external capital, if we go on to the international financial market, then we have 3 different sources. So we have bank loans, we have bonds, and then we have equity as well. So that's what constitutes topics 8 and 9. So in topic 8, we specifically focused on the international banking and money market. So we looked at different types of instruments that are available on the euro currency or the international money market, syndicated loans, because a lot of the instruments on the euro currency markets are syndicated loans that are provided to a corporation by a group of bankers who are trying to spread their risks as well as spread their capital base. And then we talked about the reasons for banks to go global. So there are strategic reasons, there are economies of scale reasons, there are, so basically those are just the 2, right? Strategic reasons that they want to expand their market share and so on. And then we also talked about what is the decision process for the many different organizational forms that banks can take on when they enter a foreign market. So we're talking about representative offices, we talked about subsidiaries, foreign branches, offshore banking centers. So you're expected to know what each of those are and how to distinguish between them. Okay? We remember there was a big chart that we talked about last Wednesday's class, something like that. And then what is the decision process that guide banks into making those decisions? So we had a specific slide that talked about what banks think about when they're choosing between a subsidiary versus a foreign branch, right? So it's all of a trade-off between the costs of operation and the benefits from having that operation. So every single topic is always a cost versus benefit study, right? Because if you expand into a foreign market, you have transaction costs, you have operational costs. Are these costs going to be covered by the expected benefit that you have? That is the really decision process here. And then we had implications on the world by having a global banking network. So there are potential benefits in having a global bank entering a local market that is being developed because they can bring in extra capital flow. They may be able to deepen the local debt market and so on. But then there are also concerns, right? There are concerns that these global banks may be able to cherry pick and take all the good quality companies in a local country and leave only the bad companies for the local banks. So that would be a bad idea. And then we talked about crisis contagion, using the examples of the Asian financial crisis and the subprime mortgage crisis to see that increased levels of connection between global banks can also increase the volatility, the correlation between market movements, right? So that is going to reduce the level of diversifications that we can expect from investing overseas, right? Because when we want diversification, what we want is that during periods of high market volatility, we want to have a guarantee, some sort of guarantee on our returns. So we invest in a different market that's hopefully uncorrelated with our home market. But nowadays, with increased global integration, the co-movements across different markets are increasing. So if one market is going bad, a different market may be going bad as well. So we have to be cautious when we're doing international investment by choosing markets that have uncorrelated returns to our home market, which is increasingly difficult to do. Okay? All right, so then we talked about, on the other hand, so all of these are on banks financing corporations. Then we talked about how do banks finance themselves. And banks finance themselves on exactly the same market, the international money market, and use pretty much the same kind of instruments. And then we talked about different funding sources for the banks. So there were how many different funding sources for a bank? Equity, deposits, and wholesale funding, right? So wholesale funding is done on exactly the same money market as we talked about in these cases. So that's why they're put together. But for the wholesale funding specifically, we're talking about interbank wholesale funding markets. But it's exactly the same market. And then we talked about potential problems and concerns with getting funding on the wholesale market. So the idea is that deposits are a stable way of funds. And if banks can get most of their funding through deposits, that would be the best, right? But deposits from retail investors and firms are limited. So they're limited, so banks will have to rely on some other choices for their funding, and so they go into the wholesale funding market. So the wholesale funding market, if everything works well, then it is a flexible market, a flexible source of funding in the short term. In the short term, ST stands for short term, sorry. What? Sorry. All right. So in the short term, they are a flexible source of funding, but and also there is a monitoring role. God, sorry, it's fluctuating a lot today. And there is a monitoring role from sophisticated investors because you're sophisticated lenders, because your lenders are banks themselves. So they are capable of verifying the kind of projects that you involve in. So theoretically speaking, if things go right, then this is a good, sophisticated source for banks to get their funds from, right? However, we talked about the case when things don't go right, as in the example of the subprime mortgage crisis, then liquidity dried up as everybody become afraid of lending money to even good, profitable companies. And then that is going to cause big problems such as the demise of Northern Rock. Okay, the next part, we went on to talking about the international bond market and equity markets. So we talked about how we would raise international capital through bonds. We talked about the Euro bonds, foreign bonds, global bonds. So you're expected to know the different kinds of bonds and the representatives of each of those. So we talked about common street names for different types of foreign bonds and Euro bonds and so on. And we also talked about the key factors that we take to what kind of bonds to be issued as well as when you would issue them. And we also looked a lot into market trends. Market trends are really important in this part. Well, market trends are really important in international finance in general, is that you know what kind of, is it a good environment for you to issue bonds, or is it a better environment for you to issue equity? So what is the market like? So that tells you a lot about what kind of instruments you should be using. And then we also talked about how to raise international capital through equity issuance. We talked about the two main ways of Euro equity issuance as well as cross-listing. And then we focused on how we choose, if we go cross-list, what kind of stock exchange we might want to cross-list on. So there is the topic of liquidity and value add that we talked about. So basically, these has to be consistent with a firm's goal. Right? Because otherwise, again, we always go back to the fundamental question. Why don't we stay domestically? If we want to go out, there's cost to going out. What is the benefit to us taking on the cost of going out? So we always have to think back to what is the firm's objective in going to raise capital internationally through equity issuance, right? We talked about the case of Alibaba. Alibaba issued its cross-border IPO on the NYSE. We also talked about how it was in talks with Hong Kong Stock Exchange as well, right? But because Hong Kong Stock Exchange wasn't willing to give Alibaba, wasn't willing to go back on the one share, one vote restriction that they had on doing IPO on the Hong Kong Stock Exchange, but the NYSE allowed for that, so they went on NYSE. And now the interesting development is that I heard on the podcast yesterday that Alibaba is thinking to do a second IPO on the Hong Kong Stock Exchange. And they're doing that because the Hong Kong Stock Exchange is willing to look past the one share, one vote policy, right? So things are constantly changing as markets adapt to the needs of the companies and their investors, right? So that would be something that's really interesting to focus on, and that's why we are interested in looking and knowing market trends. And then we talked about, again, we emphasized on that it is not a free lunch to list overseas. And so you have to have a clear idea of what is the cost and benefit trade-off. And then we talked about how do firms cross-list through the depositary receipts that is covered in the video that I recorded myself. And we talked about the difference between unsponsored and sponsored American depositary receipts. Why we focus on the American depositary receipts? Because the majority of the depositary receipts programs are done on the American market. The majority of the capital raised through depositary receipts are through the American market, right? So that is why we spent so much time on the ADRs. And for ADRs, we talked about how if they are unsponsored, then that means the company that issues the stock does not have to get involved. You basically just have a bank in the US that has demand from local investors. Hey, I want to invest in Singapore Airlines, but there are no listing of Singapore Airlines on the US market. They're only listed on the Singapore exchange, right? So then a bank such as Citibank would be able to have its subsidiary in Singapore and act as the foreign custodial bank and buy the shares in Singapore. And then once they buy the shares in Singapore, then they can issue the ADR as unsponsored ADRs. And then investors in the US can invest in them. And then we also have the sponsored ADRs. So in this case, the firms themselves initiate the request of listing on the US stock market, right? So that is typically the case in all of the Chinese listings and other big listings. And then you can only raise capital through sponsored ADRs because the firm requested for it. And in the unsponsored ADRs, you have no new capital raised for the firm. Okay. And then lastly, we have raised all of the funds that we wanted at a cheaper cost overseas? What are you going to do with the money? As a firm, what are you going to do with the money that you have just raised or borrowed? Invest, right? Because you still have to repay the interest payments, you have to repay the principal, you have to give back to shareholders so that they want to continue to invest with you. So that's why it leads naturally to topic 10. We're looking to use the money that we have just raised and invest them overseas at a higher return, hopefully. Right? So then we talked about how firms can expand into the global market. You can simply just export your products that's produced at home overseas, or if that is not enough, if you don't have the capacity to produce as much as the international demand, then the next step you can do is to go for licensing, right? So a lot of the Disney and Marvel characters are licensed worldwide to many different countries so that you can have Disney t-shirts, Disney character t-shirts, toys, and so on made. So that is a way to do licensing. Or if you want more control, then you go for franchising. What is an example of franchising? McDonald's, exactly, right? All of the different McDonald's worldwide are franchisees of McDonald's International in the US, which is the franchisor. So basically, they give the right to other different franchisees worldwide so that there is uniformity in the product and uniformity in the services that they give you. So that the Big Mac that you eat in the US is hopefully exactly the same as the Big Mac that you will eat in Asia or Europe and so on. But of course, in the first class, we also talked about how they may taste a little different. But anyways, they want to try for as much uniformity as possible. So if you still want a little bit more presence in the foreign market or freedom to do things, then you can go for the next one, which is the strategic alliance. What is an example of strategic alliance that we all know? Yes, so all of the major airline alliances that we all know, Qantas and Cathay Pacific and British Airways and Emirates, they're in which alliance? One World, right? They're in the One World Alliance. So basically what does that mean? If you take their flights and continues on to other flights by companies in the same alliance, then your tickets may be lower, right? And you can earn points and so on, do lots of things. So everybody in the same alliance can have better business, right? So they are able to pull their resources together to achieve a common goal, which is to increase their flights, their customer base. But in strategic alliance, they still remain as separate entities. And if you want to have more of a skin in the game kind of operation, then you want to go for joint ventures. So there are also lots of joint ventures in the world right now, right? So Apple and Volkswagen has a joint venture to develop driverless cars. So what does joint venture do? So basically you have Apple and Volkswagen both investing resources to create a new joint venture that focus on just developing driverless cars. So this one is a bit more risky than strategic alliance because you are developing an entity, an entirely new business entity, and you have responsibility for this new business entity, right? You can't just pull out as quickly as in the case of a strategic alliance. Because in the One World Strategic Alliance, Cathay Pacific was the one who started the One World Alliance. But now Cathay Pacific thinks that it is not getting as much out of this alliance. So it's actually thinking of exiting from this alliance, right? So you get a lot more freedom on strategic alliance than joint venture. Joint venture requires more commitment, more investment, and more skin in the game. And then finally, if all of those doesn't quite satisfy your needs, then you will go for FDI, foreign direct investment. So you will go for greenfield investment where you will invest money and capital in a foreign country and create facilities and factories from the ground up. Or you can do cross-border mergers and acquisitions that you will buy up an existing foreign business, right? So we also talked about the benefits between one or the other. With this one, you would definitely have the most level of control in the operation of the business, right? So I used an example of how for luxury chains, such as Four Seasons, if you want to ensure a brand image and 5-star service for customers around the world, then you may want to go for foreign direct investment rather than having franchisees or strategic alliance, right? Because even for McDonald's, they have this uniform process, but Big Macs may taste differently. And different McDonald's may have different products. So there are some variation in the quality of the things that they give to you in franchises. But in FDIs, if you have direct control of how things are run, and you care about the brand image and the uniformity of services and products, then you will go for maximum amount of commitment and investment. All right, so all of these are very important. And then we have this OLLI paradigm that has the 3 principles of ownership advantage, location advantage, and internalization advantage that we have to look through and ask ourselves questions on, is it worthwhile to go international? And if we are going international, what kind of the entry mode are we going to choose? So those are quite important as well. So these are all a trade-off between the cost and the control that you want. And then we also talked about macro level kind of risks, political factors, social factors. So social factors is more of cultural integration that we have to be concerned about. And then we also talked about how we might overcome these problems. So basically the idea, the same as in part 3, we know what the risks are, we identify them, and then we plan for them, right? So even though it seems like a lot of different types of material, the fundamental way that you approach answering them are all the same. First of all, what am I getting out of this, right? I'm looking for my benefit. I identify the costs, and then I compare the benefits and the costs, right? And then, once we know the benefits and the costs, then we can come up with ways to deal with them. So this course basically gives you the tools, the toolboxes for you to do the cost and benefit analysis and what you can use in order to manage them. All right? So that... Okay, just before I wrap it up, we still have a few special topics that we talked about for the last part, which are the crisis contagions that was in the international banking market, right? We talked about how the problem in one country, such as the US, can propagate across the world. And then we talked about wholesale banking fragility, how the subprime mortgage crisis told us that there could be problems from over-reliance on the wholesale banking funding market. And then we also focused on how the special case of Chinese firms doing a lot of cross-border IPOs on the US market. And we discussed the market trends and the decision factors that are involved in the process. So these are all quite important. Okay, so that's a wrap. And that's about it, right? So I just basically went through the flow, and you just need to fill in some of the details, and then hopefully everyone will do really, really well. So let's take a short break, 5-minute break, and then we can come back and do some questions that you have posted on the survey. Great. The sponsored DR, but the sponsored DR is the so they are the ones. Yes, and they are the ones who approach the U.S. investment to do this. The listing. So they are the investment bank and the person file in order to they so it's with because you're preparation. So basically, so if you actually go back, if the idea is, do you have a pen? So basically, Singapore. Impact. To do. So now. Basically, it has to ADR. You could have one ADR that first, but you can that total. Yes. Yes. But it's just if you don't. So without Singapore Airlines, so if there are 1,000 shares to begin with, right now 1,000 shares Whereas in the case of a sponsored, so then the 2004, or it could be held in registration. It could, but the entire structure. Usually does. But in the case of the sponsored ADR, could be with the new issuance, it has been registered. So it's cleared by the U.S. government. So the passing, then in this case, we're talking because if we're talking and if we're talk and then okay, so go back and try. Then there is also, I think, if we were talking about a market, if there are any capital. All right, so let's start again. So now it is time to go over some problems that I have collected through the poll. Thank you for submitting those questions. The first question is a question on the sample final, question 4C. I did say that I'm not going to give solutions to these questions, so I'm not going to give solutions, but I'm going to just talk about these. This is an example of a case that I have not directly talked about in class, this specific way of talking about a problem. So basically the idea here is benefit from international diversification. Right? And then this is the part that we have talked about. The part that I did not talk about is the calculation of the hurdle rate. And to calculate the Sharpe ratio from investing in the local portfolio versus an international portfolio. Right? So you will not see a question that asks you to do something like this, but you may see a similar problem because it's related to international diversification. So that's the extent of what I'm going to talk about on this question. Any questions? Okay. I'm going to load this onto Waddle, so don't worry. You're going to see it tonight. Okay, Second question, it's a question 4 from problem set 3. Okay, so in this question, I basically got the quotes from the CME group on the futures between Mexican peso and the US dollar. So the dates, the maturity dates are for June 2019. The settlement price was going to be about $0.05234. And the contract unit is about 500,000 per unit. So basically, then you think that the spot price in June is going to be this rate. The current contract price is this rate. Question 1, what speculative position would you take to attempt to profit from your beliefs? So this is a speculation because you're forming a market view on what peso US dollar is going to be like in 1 month's time. So if you believe the rates are 0.05752, the current futures rate on Mexican peso and US dollar is 0.05234. Are you expecting peso to appreciate or depreciate? Appreciate, right? So you're going to expect Mexican peso to appreciate. So how are you going to speculate on your position? So you believe that in 1 month's time, the spot rate is going to be higher. The futures contract has a lower price right now. So you can buy Mexican peso at a lower price if you entered into the futures contract. So what should you do if you think that you're going to speculate using the futures contract? Are you going to take a long position in the futures or short position in the futures? Long position. Long or short? By taking on the futures contract, you are taking on the obligation to buy peso at that rate. So are you going to long the futures or short the futures? If you long the futures, you are going to buy it at this price. If you are going to short the futures, you are going to sell it at this price in 1 month's time. So you're going to long the futures contract, right? So you're going to be able to buy it at a lower rate, and then you can turn around and sell it at the spot rate for a higher profit, right? Okay, the second question, calculate your anticipated profits, assuming you take the position determined in number 1 with 3 contracts. So the position that you took in part 1 is to long the futures, right? So you long the futures and you take on 3 contracts. So if you take on 3 contracts, that's going to give you exposure in terms of this, 500,000 Mexican peso. So that's how much peso that you are promising to buy in 1 month's time. And so what is going to be your anticipated profits? What is your profit here? and the spot rate, the difference between the spot rate and the forward rate. So we're going to have the anticipated spot rate, which is higher than the forward rate, right? So we have that. Okay, so then that gives us 3 times 500,000 times 0.05752 minus 0.05234. So then you're going to get roughly that much as a profit. Well, no, let me emphasize, as expected profit. Right? You have to realize that it is expected profit because you are speculating. It's not for certain that the spot price is going to turn out to be 0.0572, right? So in your answers, if you have this question in your exam, you have to be able to say that it is expected profit, right? It is not for sure. Okay, so then the next question then look at unbiased estimator. So what is the size of your profit or loss if the futures price ended up being an unbiased predictor of the futures price? So this is to test whether or not you actually get that expected profit. So in this case, assume the futures price was actually the spot price in the future. So the spot price in the future is going to be 0.05234. So then in this case, what is your expected profit or loss? Did you say something? 0, right? Exactly. Let's be brave. So basically then this turns out to be exactly the same as your spot price. So we just plug it into this formula up here. S minus F is exactly 0, so you're going to have a realized profit or loss of 0, right? So if we plug it into there, then we have a realized profit or loss of 0. For B, redo for A, but assume that you believe the June 2019 spot price will be instead this. So you just basically do everything, just repeat 1, 2, 3 for part B. So in this case, you are expecting the Mexican US dollar, you're expecting the Mexican dollar to depreciate or appreciate? Depreciate, right? So if you're expecting it to depreciate, are you going to take a long position or short position? Short position, because you're going to want to sell it at a higher price than the future spot price that you believe it to be, right? So then, very good. So then in this case, you're going to short the futures. So you can sell the peso at a higher price than the spot in 1 month's time. Okay, so you're going to short the futures. And then you're going to do the calculation as before. And then I can't write here. Anyways, you're going to do the same calculation as before, except for what? Now your profit is going to come from the formula of 3 times 500,000 multiplied by F minus S, right? Because you actually believe that the forward rate is going to give you a higher outcome than the anticipated spot rate. So then you do that, and then so for part 2, you're going to get 3 times 500,000 multiplied by 0.05234 minus 0.04716. So that is going to give you exactly the same because I manipulated the numbers so that they are going to give you exactly the same value. All right. And then we repeat the same thing, and we said that what if the future spot price actually ended up to be exactly the same as the forward price? Then in that case, our expected profit or loss is 0. Yes. So again, this is the realized outcome, whereas this is the expected outcome. Right? So with speculation, it's always expected because it's never guaranteed. Any questions on this? All good. Very good. Okay, next question. So question 1 from problem set number 4. Suppose that your US-based company has an equity position in a French firm. Discuss the condition under which the euro-US dollar exchange rate uncertainty does not constitute foreign exchange exposure for your company. Okay, so these are basically the idea of, you can think of this as the Toyota investment case, right? You invested in a French company, so the value of your investment is going to be in terms of the euro, right? And once you want to realize your profits, because you are a US company, then you have to repatriate the profits and convert it into US dollars. So we're looking at in what direction does the stock price has to change in order to offset changes in the exchange rate. So let's do it through an example. So suppose the current, actually why am I doing it in red? Let me do it in blue. Okay. So we have the euro-US dollar exchange rate. Suppose it is 1.12. It is not suppose, it is the current rate right now. Okay, so then you actually, per stock, the value of the French company is $50 per stock. So suppose you are converting the value of your company back into US dollar, how much are you getting? You just multiply them. Very good. So in US dollar terms, this is 50 multiplied by 1.12. That gives you 56. Okay, so then the question is saying that if the euro depreciates to euro over US dollar of 1.1, then what is the US dollar value of your equity position? You multiply this again. 50 multiplied by 1.1. So that gives you roughly about 55. So the question is asking, in what direction does the stock value has to go in order to offset the negative impacts on the stock on the foreign exchange rate movement? Offset, it cancels out the decrease in value, because compared to before, the US dollar value has dropped by $1, right? So by saying that when it doesn't actually have foreign exchange rate exposure, you're going to have exactly the same value. You want to guarantee that there's $56 in US dollars. So what has to happen to the value of the French company to guarantee that there's 56? I think you all know it. You're just a little concerned. Yes, just increase, right? So in order to have zero FX impact being realized, the stock has to increase by, how do I calculate the increase? How do I calculate the increase? Because I said that I want to guarantee that at the end I have 56 US dollars. Divide, right? So we're going to just divide 56 by 1.1. Very good. So that means you will have to be about 50.90 or 50.9091. So basically, that's the idea. Your euro value of the stock has to increase or opposite to the direction of change of the FX exchange rate in order to offset or net out the impact on your US dollar value. Questions? Concerns? All good? Cool. Let's move on. Okay, so the next question is question 2 on the same problem set. 1, compare hedging transaction exposure using the forward contract with that of using money market instruments. When do these alternative hedging approaches produce the same result? So if you are using forward contracts, you are dealing with what rate? Forward rate, right? So if hedging with forward contracts, we are using the forward rate. So we have F. And if hedging with money market contracts, what rate are we using? If we go into the money market, we're using the spot rates, right? We're using the spot interest rates. We lend and we borrow at the spot interest rates, right? So we're using the spot rate, S. So now we have the familiar concept of the forward rate and the spot rate, which we know that the interest rate parity holds them together, right? So in the money markets, we have the spot interest rates as well, and the interest rates. So then we know that they are going to be exactly the same result if the interest rate parity holds. So the outcomes are exactly the same if IRP holds, right? So this is a way for you to identify that, okay, if we're in the forward market doing forward hedging, then we have to use the forward rate. If we go into the money market, then we're working with the spot rates. We're working with the spot interest rates as well. So what condition unites them together to be equivalent to each other? The interest rate parity. And then if I extend this question a little bit further, then I ask, what are the assumptions for interest rate parity to hold? Right? So I said that that would be important, the assumptions for all of the theory. 2. Now this is integrated with the other parity condition, which is the purchasing power parity. Does discuss the implications of the purchasing power parity for competitive exposure. Okay, so the idea here is, under what conditions does purchasing power parity hold? That was tested on the MISMaster exam. Competitive markets, right? See, you know them. I think all of you know them. You're just a little shy. So PPP holds if there is a perfectly competitive market and capital markets. Right? So there are no transaction costs. You do not have non-substitutable goods. You do not have luxury goods and so on. So that all of the price differences is going to be able to be arbitraged away. So then in this case, this is basically the condition that we are looking for. And then we're just going to talk about how the rates, ST+1 rates and ST rates, are going to be balanced by the price levels in the two countries. So the inflation rate differential between countries will be balanced. Okay. So this question mainly identifies whether or not you are able to understand what kind of instruments you're working with when you do different kinds of hedging, and whether or not you remembered assumptions for the different parity conditions. So this is an example, a really good example of when I say you need to be able to connect between different topics. Okay? Questions, concerns? All good. Okay, the next question from the same problem set, question 3.2, part 2. So here it is on testing whether or not you are quite aware of what constitutes translation exposure, economic exposure, transaction exposure, and so on. So we have two companies, Canop and Xeon companies are US companies of similar sizes. Both conduct most of their businesses within the US and also owns international businesses as well. Canop has a subsidiary in Canada that generates earnings of Canadian dollars 20 million for each of the next 5 years. It also has a US business that will receive Canadian dollar 1 million for each of the next 5 years as a result of exporting products to Canada that are invoiced in Canadian dollars. So before we go on, the Canadian dollar 20 million, What kind of foreign exchange exposure does that sound like to you? Translation exposure. Why? Because it is earnings by subsidiary, right? So then you have to repatriate the profits back to the book of the parent. So that is the translation exposure. What about the Canadian dollar 1 million? So the US business also receives Canadian dollar 1 million. Is that translation, transaction, or economic? Transaction, right? Because in this case, we're talking about its component that is based in the US. You don't have to repatriate the profits. There is no translation exposure here. It is purely a transaction exposure. Okay, let's go on. Xeon has a subsidiary in Mexico that will generate earnings of 1 million pesos for each of the next 5 years. It also has a business in the US that will receive 300 million pesos in each of the next 5 years as a result of exporting products to Mexico that are involved in Mexican pesos. Okay, so let's do the same practice as in the previous paragraph. The $1 million peso exposure, it's translation or transaction or economic? Translation, because we're talking about a foreign subsidiary's earnings, right? So in this case, okay, good. In this case, we're talking about translation exposure, and then the 300 million transaction exposure, right? Because we're talking about foreign orders for a US entity. So this is a transaction exposure. All right, so the salvage value of Canop's Canadian subsidiary and Xeon's Mexican subsidiary will be 0 in 5 years, so you don't have to care about their ending value. The spot rate of the Canadian dollar is 60 cents US dollar, while the spot rate of the Mexican peso is 10 cents US dollar. Assume the Canadian dollar could appreciate or depreciate against the US dollar by about 8%, when the Mexican peso could appreciate or depreciate against the US dollar by 12%. So it seems that the Mexican peso is more volatile against the US dollar than the Canadian dollar. Which company is subject to higher degree of translation exposure? Explain. So the last explain part tells you that, okay, full marks, you need to give economic intuition. Okay. All right, so let's calculate the total. In order to be able to compare apples to apples, we want to convert the translation exposure into US dollar values so we can compare against them, right? So very good. So we compared the US dollar value of translation exposure. So for Canop, what's the US dollar value of translation exposure? Then we take the 20 million Canadian dollars and multiply it by which? 0.6. So that is going to give us roughly about 12 million, right? US dollars. Okay, what about for Xeon? We have 1 million, and we multiply that by 0.1, very good. So that is going to give us 0.1 million. Immediately, we can see that Canop has translation exposure that's 120 times bigger than Xeon, right? So Canop's exposure is 120 times larger than Xeons. What can we say about who has the larger exposure? Let's take a look at what other information that we have. We know that peso is somewhat more volatile than the Canadian dollar. By about 4%. When we are saying that CanApps exposure is 120 times larger than Xeons, are we comparing apples to apples? Why not? They're both in US dollar terms. What information do you need in order to see whether or not they're being compared apples to apples? Assume that they're all at the same date. It's all about the context. Okay, we are definitely seeing that CanApp has about 120 times larger exposure to translation in terms of translation exposure in this case. And Xeon has about 0.1 million. What additional information do we need in order to compare apples to apples? How important is this translation exposure to each firm? Like, if I have $1 million and I have an exposure of $100 versus you having $1,000, but you have an exposure of $100. Do I care more or do you care more? You care more, right? Because the relative exposure here for you is much bigger. What about here? They are of similar size, right? Okay, so the additional piece of information is that they are of similar size. So we're talking about the context so that we are comparing apples to apples, right? So the additional part here, we can say this statement because they are of similar size. Right? So that is the additional mark that you're going to get for recognizing that. Because otherwise, the comparison is not fair. Like what I said, if I have $1 million and I have an exposure of $100 versus you with $1,000 with an exposure of $100, it's a very different comparison if you're only comparing the net exposure, right? So we have to place it in context of the size of the company, of our overall position. So you have the information there that you have to make and take into context in order to come up with the question, right? So you would expect that. And so, given that it is 120 times larger and they're of comparable size, even though the Mexican dollar is a little bit more volatile than the Canadian dollar, the size of the exposure simply dwarfs the volatility. And so the CanApp company will have more translation exposure for sure. All right? So this is the calculation part, and this is the Y part. Well, actually, the whole thing is the Y part. Yes? Yes. Yes.
But the exposure-wise, NAV has got a larger exposure than Xeon.
Right, so the question is, what if they have different sizes? Now, then how will we approach this? We standardize it by the company size, right? We would just take the exposure that you have and divide it by the company size to do a proportion, right?
Would we be quantified when it comes to the size of the company? Say suppose NAV is 3 times smaller than Xeon is.
You will be given the information. You will definitely be given the information, right? So that you are able to put everything into context. Otherwise, it's unfair. Yes.
So we don't have to look for value if the dollar appreciates or depreciates 12%. So for example, it says the Canadian dollar could appreciate or depreciate by 8% in a year. So I'm saying we don't have to calculate the actual value from such an appreciation or depreciation.
Not really, because I didn't give you the confidence interval. Yeah, so you can't really come up with a sort of a value at risk kind of thing. Yeah, assuming it's 95% confidence interval, then perhaps, hey, that's a really good question. No, it's going to be easy, right? Because we already went over it in class, so you will be expecting it. So that would be a good thing, because you're coming up with the final exam with me. Right, so those are really, really good questions. So the key idea is that we are going to put the question into context so that when we're comparing things, we are comparing apples to apples. If they are of different sizes, then I'm going to make that very clear to you so that if you know that you need to put it in context, then you can divide it and get a proportional exposure, right? Okay. Other concerns, questions? Great. Okay. Next question, still the same problem set. So this is, I think, a really good problem set to test all of your skills. Question 5. So question 5 is a test on regression, using regression to measure economic exposure. So DSQ is a US firm that attempts to determine its economic exposure to movements in the British pound. By applying regression analysis to data over the last 36 quarters, we have this regression model where SP represents the percentage change in DSQ stock price per quarter. E represents the percentage change in the pound value per quarter. And epsilon is an error term distributed normally. Based on the analysis, the alpha coefficient is 0, and the beta coefficient is negative 0.4, and it's statistically significant. Assume that interest rate parity exists. Today, the spot rate of the pound is $1.80. The 90-day British interest rate is 3%, and the 90-day US interest rate is 2%. Assume that the 90-day forward rate is expected to be an accurate forecast of the future spot rate. Okay, so the future spot rate is expected to be $1.80. Would you expect that DSQ's market value to be favorably affected, unfavorably affected, or not affected by its economic exposure over the next quarter? Explain. So this goes back to the idea of that if beta is greater than 0, right? If your exchange rate value increases, what would you expect in the value of the stock? Increase or decrease? Increase. And if beta is negative, if this increase, then you would expect SP to decrease. So it's an inverse relationship. So here, because beta is negative, we're expecting an inverse relationship. So the next step that we have to do is to figure out whether we are expecting the pound to appreciate or depreciate. So because we are assuming the interest rate parity holds, let's take a look at what the interest rate parity tells us. Okay, so in this case, what do we know? This is equal to 1 plus the foreign rate of interest is 0.03 plus 1 plus 0.02. So actually, without calculating anything, we know that this is greater than 1, right? So if this is greater than 1, what does that mean by the comparison between the forward rate and the spot rate? Forward rate is expected to be larger than the spot rate. Okay, so in this case, the forward rate is larger than the spot rate, and because of the quotation style, is H over F. What does this mean in terms of the dollar value over the British pound value? So we're saying that the F rate in terms of US dollar over, let me just do the, US dollar over pound is greater than S US dollar over pound. So is the pound selling forward at a premium or discount? Or is the pound expected to appreciate or depreciate? For every dollar, the F is going to give you more pound. Depreciate, right? So you're expecting that the pound is going to depreciate. Analogously, you're expecting the dollar to appreciate. Right? Okay, so now, again, looking at this, we're expecting the pound to depreciate. So E is positive or negative? It's negative, right? Because we're having a negative change, so E is negative. And since beta is negative, I guess instead of negative, we're just saying E is decreasing. And so what's going to happen to SP? Increase. Increase, right? Because we're talking about inverse relationship. So SP is going to increase, and so DSQ's market value is going to be favorably affected by the change that we have just talked about. All right? So this is another example of integration between the international parity conditions versus risk measurement. So that's why I spent so much time in the first two big topics, because they are the foundation for everything that we're doing afterwards. Questions, concerns? All good. Next, let's go on. Okay, so the next question is, again, from the same problem set. Question 7. Today, the spot rate of the euro is $1.20. The 1-year forward rate is $1.14, free of arbitrage. A 1-year call option on euro exists with a premium of 0.04. So now whenever you see an option with a premium, you have to note it down. And remember to include the cost in your calculations, right? Because it's always costly to enter into hedges. So this is important. And an exercise price of $1.17. You think the spot rate is the best forecast of future spot rates. Your US-based company will need to pay 10 million euros in 1 year. Suppose the interest rate is 4% per annum in the US. Determine whether a forward hedge, a money market hedge, or a call option hedge would be more appropriate to hedge your payables. Okay, so this is a comparison of costs between the usage of these 3 hedges. In the class example, we looked at a case of accounts receivables. So we were comparing which kind of hedge positions would give us more US dollars. This one is looking at accounts payables. So we're looking at which of these 3 hedges will make us pay more in US dollars. Accounts payables, right? Accounts payables, you have to pay. Your question is? No, which one? Yes. So we're trying to pick out the one that pays more and, ditch those, yes. So this is a case we're doing accounts payable, want to find the option or the alternative where we pay the least. In US dollars. Okay, so the first one, okay, so let's do the forward market hedge. If we enter into the forward market, we have the forward rate of 1.14. So that means we have to pay this much euros in the future. So we're going to lock it in today, right? So we're going to do 10 million euro multiplied by the forward rate of 1.14. And so that is going to give us about 11.4 million in cost of US dollars if we entered the forward hedge. Good. Money market hedge. So money market hedge, we need to work with the spot rates and interest rates. Interest rates domestically and interest rates on the euro. Do we have all of the information? We have the spot rates of 1.2. We have the domestic rate of 0.04. What we do not have is the foreign rate, right? So here is where you have to refer back to your derivatives class. But we have actually talked about this. We had this formula in, I think it was a topic in one of the slides. We had this formula in one of the slides. I'm not going to just be clear. I'm not going to give you anything that you haven't seen in this class. So this is on the question just because it was on the slides. Right? So the forward price is calculated as the spot price multiplied by 1 plus the domestic rate of interest minus by the foreign rate of interest. And this is the time horizon. So with this formula, you're going to be able to back out the interest rate on the euro, right? Because you know what the F is. The F is 1.14. Spot rate is 1.2. 1 plus 0.04 minus, this is what we don't know. Time horizon is 1 year. And so if we back everything out, that gives you 0.09 per annum. And that is the I of euro, the interest rate on the euro. Right? So again, this formula was in the question only because we have also referred to it in the class example. Right? I am never going to give you anything that I have not shown you in anything else. That you can be sure of. Okay, so this shows you a way of how different courses are connected together, right? So I emphasize on connections. Okay, and I show you those connections, so you shouldn't be caught by surprise. Okay, so if we enter into the money market hedge, so basically the idea is that you're going to borrow the value of the euro that you have to pay tomorrow in US dollar terms, and then you're going to have enough to pay back the dollar loan. So here, find out what is the present value of payment of euro payment tomorrow in 1 year. So this is going to be 10 million times 10 million divided by 1 plus 9%. Right? We're using the interest rate on the euro in order to get the present value of what we need today. So this is in terms of the euro, and it's going to be 9.174,31193 million. Okay? So you know that is what you need today. So what you're going to do is to borrow this much in terms of the US dollars. So how much do you need to borrow? You take this and multiply by the spot rate. Yes. So you're going to take 9174311.93 and multiply by 1.2. And that gives you roughly 11,009,174.32. Okay, so that's what you borrow today. And then what are you going, and so you can convert this into euro today, right? You're going to convert the loan into euro and invest in the interest rate on the euro, right? So you're going to take all of that, so then in 1 year's time, you're going to get exactly 10 million. Right? So you're going to convert it at a spot rate by multiplying that by dividing that by 1.2, and then you're going to multiply it by 1.09 in order to get that much. So this is what you get. So you can finance your accounts payable. And then you need to repay the dollar loan in 1 year. And so in 1 year's time, how much do you have to pay back? You're going to take this, multiply by what? 1.04. So that's the interest plus the principal. So that is going to give you, yes. So that's what you need to pay in 1 year's time. And that is going to be your cost in 1 year's time. Right? So we're comparing this one with this one. And finally, we have one last option to do, which is the option hedge. So with the option hedge, you're going to purchase each option at a cost of 4 pennies per option, right? So in this case, when are you going to exercise the option? The strike price is 1.17. Your expected forward price is this, right? But anyways, it doesn't matter. When are you going to exercise the option? If the spot price is greater than this price, right? So you can buy it at a cheaper rate in the future. So if you buy it at a cheaper rate and you exercise the option, if exercised, what is going to be your cost? 1.17. Be a little bit more careful here. Yes, we have to account for the premium. Here, remember, the 1.17 per euro, you have to pay it. You are paying 1.17 US dollar for 1 euro, right? You're paying out. The cost of 4 cents is also paying out. So you have to add them together, right? That increases your cost of buying, right? Yes, very good. So that's what we have, and then that increases our cost, and we multiply it by the total euro liability that we have to pay, and so that gives us 121,000. So this is the comparison. So we are comparing this one, and this one. Which one is the least costly? The first one, the forward hedge. Right? So comparing the cost of all three. So comparing the cost for all three. All options, the forward hedge is the most cost effective. All right? Questions, concerns? Yes? Yes? if we use the it's always flipped. If you have H over F, then it is F over H. The price currency is the foreign currency here. So it is in the denominator. So actually the idea here is if you have H over F, then what you see here is always F over H. It's always flipped on the other side. The price currency is the F here. It's the foreign currency. So because the quote can always be given to you in indirect quotes as well as direct quotes, the best way to remember is you just flip them. If on the left-hand side you have H over F, then on the right-hand side you have F over H. I think that's the easiest way for me to remember. Very good. Okay, next question, question 2 from problem set 5. So this is a question where we started to calculate value weighted average cost of capital that separates the cost of capital before and after you raise international equity or international bonds or financing. So in this one, you're basically given all the relevant other relevant rows, sigmas, correlations, and risk-free rate of interest, and so on, before diversification and after diversification. So diversification here means that you may actually go international and have international sources of funding. So that after diversification, you probably have slightly lower correlation between the home market and your country, and you also have slightly lower standard deviations in your returns. So the question is, calculate the company's cost of equity before and after the international diversification of its operations. So this question is really about knowing which formula to use. Right, so once you know what the formula to use, and then before diversification and after diversification, you just need to plug into the values accordingly. So in this case, I think you're given this formula on the formula sheet. You're given this formula on the formula sheet, right? And then, are you given this part? Are you given this part? No? I can add it on. Do you want it to be on? No? By show of hands, who wants it on? Yeah, okay. I guess it's majority. So, okay, I guess that's the only thing that probably stumps you a little bit about remembering the formula, right? Otherwise, I think the question is just plugging into formula and understanding that after diversification, you have a lower cost of capital because of international diversification. So that's pretty much the idea. So, okay, very good. I am going to change the formula sheet by adding on this part. All right? Yeah? All good? Cool. Next question, problem set question 6. So in this case, you are an investment banker advising a Eurobank about a new international bond offering it is considering. The proceeds are to be used to fund Eurodollar loans, which is a floating rate loan to bank clients. What type of bond instruments would you recommend that the bank considers using? Why? So basically, it's telling you what the bond is being used for. So you're raising financing with bond to pay floating rate loan. So the idea is what kind of bond would you want to issue? So if you have floating rate loan, that means every period t equals to 1, t equals to 2, t equals to 3, and so on, up to maturity of the loan, you have to pay different rates, right? So it could be something like 1% plus LIBOR. And LIBOR itself changes every period, so that's why it's floating, right? So what if you wanted loans specifically to pay off this debt, what kind of bond would you issue? You're raising a bond in order to pay off a loan. What bond would you issue? Well, you want to match the maturity and you want to match the coupon payment that you have to make, right? So you want to match maturity and coupon payments. So every one of these you have to pay out. So this tests whether or not you are aware of the different types of bond instruments that are available at your fingertip. So in this case, we're going to issue a bond with exactly the same maturity, right? We're going to have a bond with the same maturity. And basically, we're saying that for every one of these periods, we should be getting income in order to offset the payments that we get, right? So basically, then we need to get income of 1% plus LIBOR. On that, that's perfectly matched. So what type of debt instrument does this correspond to? Floating rate notes, right? So we're going to have, a floating rate note with the same maturity, exactly to just offset the payments that we need. We can customize this, yes. So you can just chat with your friendly banker and say that we need a floating rate note for exactly the same maturity that matches exactly the same type of payments every quarter or every month, and then you can just do that. Okay? Questions, concerns? Nope, very good. Next one, problem set 6, question 5. So this is talking about DSQ, our favorite company, which is a US firm with a Chinese subsidiary that produces cell phones in China and sells them in Japan. Why do you think that they are having a subsidiary that is based in China but sells in Japan? Why don't they have the subsidiary in Japan? Labor cost, right? So again, it goes back to the idea of that if you want to have a foreign expansion, there must be some locational advantage. It could be labor cost, it could be whatever, but there must be something that draws you to that. So this is choosing to have a subsidiary in China because of lower cost, but it's pretty easy to ship items to Japan because they are close, geographically speaking. So the transaction cost of the production versus the sales is pretty low. This subsidiary pays its wages and its rent in Chinese yuan, which is stable against the dollar. The cell phones sold to Japan are denominated in Japanese yen. Assume that DSQ expects the Chinese yuan will continue to stay stable against the dollar. The subsidiary's main goal is to generate profits for itself and reinvest its profits. It does not plan to remit any funds to its US parents. So this says that we're not concerned about any translation exposure. Okay, so this question is purely on foreign direct investment and location choices. 1. Assume the Japanese yen strengthens against the US dollar over time. How would this be expected to affect the profits earned by the Chinese subsidiary? Okay, so if yen is expected to appreciate against US dollar over time, the Chinese yuan profits is going to appreciate, it's going to increase, decrease, or remain the same? Increase, right? Because first of all, we assume the Chinese yuan's exchange rate against the US dollar is pretty much stable. And if the Japanese yen is going to increase against the US dollar, then that means it's going to increase in value against Chinese yuan as well, right? So in this case, even if you have the same amount of sales, that's going to increase the amount of Chinese yuan floating to the Chinese subsidiary. Yes? Yes? Right? Because, again, let me do it again. Because the yen is expected to appreciate against the US dollar, and because the US dollar is pretty much pegged 1-to-1 with the Chinese yuan, so the Japanese yen is appreciating against the Chinese yuan. Right? So even if the amount that's sold remains the same, you're going to have more Chinese yuan floating to your Chinese subsidiary, right? Because the increase of the Japanese yen against US dollar should not affect anything, right? It should not affect domestic demand within Japan, right? So you're not assuming no change to Japanese demand in this case, because you're selling the cell phones to the Japanese in Japanese yen, right? So the change in the foreign exchange rate of the Japanese yen against the US dollar should not have any impact on domestic demand. And assuming the same level of Japanese sales, then there's going to be more Chinese yuan floating to the Chinese subsidiary. Yeah? Yes? Okay. 2. If DSQ had established its subsidiary in Japan instead of China, would the subsidiary's profit be more or less exposed to exchange rate risk? Less, right? Why is that the case? Yes. Exactly. Yes. So basically, all of the cost is in Japanese yen. All of the sales is in Japanese yen. So overall, you're not going to have any transaction exposure. You don't need translation exposure in this case anyways, right? And so because we are talking about you do not plan to remit any funds to the US parent. So we took away the translation exposure. So we are only concerned about transaction exposure in this question. And once we have all the cost and the sales, both in Japan, that will eliminate the transaction exposure. So you're going to be facing less exposure to foreign exchange rate. However, I think the answer here misses one point, and that is another locational advantage part, which is what if most of your inputs has to come from inputs that are produced in China? So we're not even talking about labor cost, right? If the subsidiary actually have dependence on Chinese produced raw input, such as mine, commodity, and things like that, then there's still some transaction cost, right? So it really depends on the question, because the question here doesn't specify that it has reliance on Chinese input, raw input. But if there is Chinese raw input, then there is still some transaction cost. 3. Why do you think that DSQ established a subsidiary in China instead of Japan? Assume no major political costs, uncertainty, right? So we already answered the question at the beginning. The locational advantage comes from lower labor cost. Of Four, if the Chinese subsidiary needs to borrow money to finance its expansion and wants to reduce its exchange rate risk, should it borrow in US dollars, Chinese yuan, or Japanese yen? If the Chinese subsidiary needs to borrow money to finance expansion, but still wants to reduce its exchange rate risk, so in this case, we're talking about transaction exposure because we just eliminated translation exposure. What currency should it choose? Japanese yen. Why? Okay, so let's see. So we want to borrow money. We want to borrow money, and if we borrow money, we have to pay it back, right? We have interest payments, we have the final principal payments. Okay, so we need to pay it back. Where does the Chinese subsidiary get its profits or earnings? Japanese sales, right? Somebody mentioned it. It gets its sales from Japan. So its revenue is created in Japan. So the income is denominated in Japanese yen. We want to match it with the cost. So we're going to borrow in Japanese yen. Yes, so this is a case of natural hedge. You want to adjust your operational structure so that you're going to minimize your net exposure to foreign exchange rate risk. So you need to pay it back. All of its income, all of its earnings are in Japanese yen. So it makes sense to borrow Japanese yen. So it makes sense. Oops.
Thank you.
So it makes sense to borrow in Japanese yen. So your net exposure to Japanese yen is reduced. So this is a way of how natural hedge can come into place to help you to hedge your exposure. And this is actually a question that integrates topic 10 with topic 6, right? So all of the following problem sets that you see just the examples of how different topics can be tied together, right? That tests how well you know each topic. So please be aware of that, and don't be too concerned. It really just depends on whether or not you do remember all of those. And just calm down and read the question. All right, so that pretty much wraps up our entire class. Thank you very much for the 12 weeks that you spent together. Thank you so much. And I really, really wish you all a wonderful, wonderful time in the rest of the program and do really, really well. Thank you, and have a great break and term and year. Thanks. Okay.
Can you upload the noted slides of lecture 10? Yeah, because we just have the unnoted.
I will try to. The problem is because I have I took the video with the PAPT. It's very large right now because it recorded all the things that I did. So that's why I didn't do it. Because it's like 56 megabytes.
Okay.
I need to figure out how to get rid of all the recording. I haven't figured out.
Okay, thank you.
You're welcome.
I think it's okay.
Hi.
Can I ask you a question?
Of course.
What?